Unfiltered opinions.
Introduce me.
Sometimes you have ideas and you're not quite sure why.
As you secure the bag.
Sometimes you meet people and realize there's probably a reason why you stayed in touch.
Just listen.
Sometimes all the pieces just come together by themselves.
I'm Jimmy Moyaha.
I'm Nicolette Mashile.
And I'm Simon Brown.
Welcome to Insider Exchange.
Welcome to another episode of Insider Exchange. We're grateful to keep having you come back to listen to the things we have to say. We start off with market matters as we always do, and in this week's market matters, South African inflation numbers, the inflation print coming through better than expected. We're going to look at that. We're going to look at Jackson Hole, the symposium kicking off on Thursday, and we're going to look at what the expectations are around that. And then we're going to take a look at Shein. They've decided to sue Temu. We're joined in studio by our sponsors, Danny Mawas, CEO of Finalto South Africa, as well as Ruan Landsberg, market analyst at Finalto. Gentlemen, thank you as always for taking the time to come sit with us and talk about these things. Let's start with Shein. Why would you? Are you just jealous that your competitor's doing better than you? What's happening?
I think it's just they had this monopoly in the cheap labor market where they were running all these products, and now they have competition, and now they're obviously getting mad for the third time in like 3 years. So I don't get it, to be honest.
I got a different view. It's marketing because we're talking about them.
Yeah, exactly. Well, that's true.
It's marketing for both, right?
Well, actually, they're colluding, right? I mean, I don't know. It just, I read the article and I just like, you're claiming that they rip you off, but don't you rip off everybody? I mean, like...
Well, both of them are using the same suppliers.
Yeah, exactly.
So,
it's the same supplier.
And it's the same strategy.
It's the same strategy which you order and then you produce. I mean, it's all the same, and it's getting through the loopholes because the same tax loophole we have in South Africa exists in
the US. But they're actually looking to stop it from what I was reading.
Of course. So, I mean, they're exactly the same, and now they're suing each other. It's like, I don't know, that's weird.
Yeah, the third time now they're suing them.
I didn't even know it was the third time.
But both brands have been sued by I don't know how many thousands of
or the proper manufacturers.
So they get they get sued for forced labor once again because obviously they moved to Singapore now, but they still have the operations running in China. And I mean, it's
and copyrights.
Yeah, exactly. Yeah. And now what's happening, obviously, is they using the same suppliers, and now it's getting to a collision because the supplier is giving you a cheaper product, the supplier is giving it to you somewhat more expensive, and that's obviously causing the whole thing to obviously unravel. And now the suppliers isn't working with this brand or not working with that brand. Of course.
So how do you navigate this? I mean, you're going to sit in front of some federal judge in the US. You have to explain what's happening. And if it is collusion, then what? You settle out of court after a period of time?
But also, I don't understand why they're suing in the US. Neither is a US company.
That's the other thing.
But from what I understand, their biggest market share is actually in the US.
Yeah, sure.
And the easiest place to sue is in the US because you can sue for anything in the US, apparently.
Yeah. I mean, I don't know. I mean, surely they do settle. Surely this is, I don't know, pistols at dawn, but at like just before dawn, you come to your senses.
I've watched John Wick 4. It doesn't end that way. While we're in the US, Jackson Hole kicked off this week. Arguably one of the biggest Jackson Hole symposiums we've seen in recent times. But at the same time, the market seems oddly calm about it.
I think the market has been expecting it for a very long time. I mean, let's just say the market is expecting definitely some sort of rate cuts. Lots of policymakers have been making a lot of noise about it over the past 3-4 months already. So I think everything is already priced. And I think the most important thing that we need to look into is more like by how much. So if there is a rate cut, by how much they're gonna be. They're going to be reducing it. Is it like 50 basis points? Is it 25? If it's 50, then it's quite drastic. And then I think we would see like a reaction on the market. If it's 25, I'm not sure something's going to happen.
And I was looking back, the last rate increase from the Fed was 75. They want to come and give us a measly 25. But interesting, the topic this year is reassessing the effectiveness. Reassessing is an interesting point. Reassessing the effectiveness and transmission of monetary policy. Which, as I understand, and I'm not sure I do, is that after the highest inflation in 40 years, I mean, we forget that the US got to 9%. I mean, the UK got to almost 11. We did get, I think, 11.1. that this has been sort of the first inflation since the 70s. And they're kind of like, well, did it work? And I got to say, I was thinking about it this morning. In fact, I was chatting with Martin Ackerman from Citadel. And it occurred to me, if we go back to, remember inflation was transitory? And then it wasn't. And then it was 9%.
Then it was sticky.
Yeah. And then suddenly it was 9%. I mean, so far, and let's touch lots of wood, kind of like they've worked it well. They've got it back down. There hasn't been absolute chaos. Unemployment in the US is only a little over 4%. I know big revisions this week and everything else, but I mean, so far, so good. A ways to go, but so far, so good.
Yeah, I must say, I mean, everything.
Did it look skeptical?
I don't know. We've seen this play out. Ruan, give me your thoughts and then I'll
I
weigh
just
in.
think in general, like, I mean, everything with all the chaos that's been happening, it's weird that the market has actually been stable. I mean, we spoke on the previous podcast that dollar should be dropping, starting to slow down the upside momentum. Now it is dropping finally, but I mean, through all that chaos, it stayed stable.
That's easier to achieve when you are the dominant currency, when for the last 70 years you've dictated to global markets how things should be done, how things should be priced. Think about the entire monetary system as it stands, right? Everything is pegged, pinned, benchmarked, circulated around the US dollar. So if you are then to have that sort of center of the ecosystem that everything sort of orbits around, then you have to have that stable. You don't have the opportunity to have, or you can't afford to have that move around, right? And for me, that's kind of what I'm seeing with the US picture is the US has put themselves in the position where for years, decades, they've been able to dictate to the rest of the world what you can and can't do, what makes valuation sense, what doesn't. And that's why you have three companies in the three companies on the S&P that have the same market cap as entire GDPs of countries, you know, because if your economy is the one that's supposed to do the best, then for as long as that is the case, everybody will ignore the fact that you have a $34 trillion debt level. I mean, we cry about a debt to equity ratio that's approaching 60, debt to GDP that's approaching 70 or so, or even 80 odd percent. What is the US?
120. So then I was thinking, so what's different between now and the 70s? And then, of course, I realized OPEC and gold standard. So there were significant differences. And then I come back to your point around, and you didn't use the word, but I'll throw it out there, weaponization of the dollar.
Yes.
And what we've seen, and I've got to remember, Philip Short from Flagstaff gave me sent a chart out. The reduced buying of US dollar treasuries, which actually started by central bankers, started in 2018 and accelerated massively in 2022 when Russia invaded Ukraine. And it's not just that suddenly it's like, nice dollars you have there, Russia. Not anymore, you don't. It's like Russia comes to redeem their treasuries. What if the US government says, no? Yeah.
Who's going to stop them? And that's been the thing.
I mean, who's going to stop them? No one.
That's been the thing. For years, that's been the conversation is everybody takes their cue from the US, even with the interest rate and the inflation conversation. When Jay Powell stands up and he's taking the podium today as we record this episode. He's set to speak at Jackson Hole, and the market is waiting to hear what he has to say.
Global market,
But it's different this time, right? Because the last time we had this conversation around the positioning of the US and we were in studio, we looked at the fact that China waged a trade war. They survived. Russia. The BRICS bloc is coming out with what seems to be or what could potentially be their own currency. Russia's going through exactly what you're saying, Danny. They're standing on their own 2 feet, right? So the world in 2024 is not the same world that was dominated by the US in 1924. And the question then becomes, from a Jackson Hole perspective, what does the next 10 years or the next 100 years look like for the US?
I think my personal opinion on that is like I think there is still like a long way to go before let's say the US is like end up in a difficult situation, especially regarding their currency and the fact that they are definitely using their dollar-denominated metrics as a weapon. But what's definitely certain is that the use of cryptocurrency is actually accelerating all of these shifts and I can say instabilities on the markets and so on and so forth. I mean, we mentioned Russia. Remember when the EU, the Americans started imposing all of this tariff on them and so on and so forth. All of these policymakers were saying Russia's gonna struggle. They put themselves into a bad spot and so on and so forth. But the reality is that, like you said, they survive and they're still here and trading, no problem. And one of the reasons why they're still trading and still standing up on their 2 feet is simply because they are using, for instance, USDT to settle their trades. They are using some sort of digital assets or some other currencies to settle whatever they need to purchase for the well functioning of the country. So what I'm just trying to say here is what I'm trying to say rather is that everything is how can I put it, the use of other than dollar denominated assets is definitely accelerating, and people are looking for other kind of currencies to settle their trades, whereas 20, 30, 40 years ago everything was in dollars. And I think this era is soon to be over.
I take your point. I think it is coming to an end. And the death of the US has been promised many, many times. I think there is if you look back over history, the other big empires, the Romans, the Greeks, the English back in the 1800s, the sun never set on their empire. Yeah. The difference the US has from those is that they have the global currency, and that's Bretton Woods. And weirdly, if you go back to Bretton Woods, the debate was, should the super currency be sterling or dollar? Or should it be a sort of mergy type currency? And the decision was taken that it would be sort of like both. And then the English delegation went to bed early, and literally they crossed out sterling, and it was dollar. It looked that close to not giving them that power, but it comes from Bretton Woods, and it has given them a level of economic power, which then translates to political and military and everything else that is unheralded in this planet. And one day it'll end, if only because one day our sun goes out. I mean, but they're calling the death of the dollar and the end of the US. I mean, I remember this debate in 20 years ago, the euro, the dollar's dead. Oh, we're going to trade oil in renminbis and stuff. And to your point, it's happening. It's happening more than it did a year ago, a decade ago, 20 years ago. But man, stuff is still settled in dollar. Of course.
Stuff is still settled in dollar. And if you have any doubts around what's happening in the crypto space and you're thinking maybe crypto's the way to go, interesting stat. The Rothschilds family owns 8% of Ripple. We move on to South Africa. We move on to South African markets because we're looking at CPI and other things. South African CPI print came through this week as well. Our Fed governor, or our version of the Fed governor, Malome Lesetja Kganyago, has been adamant that he wants a 4.5% midpoint for inflation. We're not going to deviate from that. The market's been sitting at 5.1% for the longest time. Wednesday came in at 4.6%, and now we want rate cuts.
Yeah, I mean 4.6. I think that's something we haven't seen for
3 years.
3 years. Yeah. So I mean, it seems like things are definitely improving. But if you check the numbers, and I mean, if you start crunching the numbers and you go a little bit more on the granular level, you're gonna see that we're still struggling. Like if you look at food inflation rate, your cereal and bread is still quite, it's still going up actually. If you look at your, for instance, tariff on electricity and so on and so forth, it's skyrocketing. So, I mean, I think there are still a long way to go before we can say, okay, yeah, we got the situation.
I think sometimes I would just like to know where they get these prices.
I must dig in. I have interviewed Stats SA. So it was only about 2 years ago that they took CDs.
Okay.
You know what CDs are?
Yeah.
Okay.
Yeah.
They took CDs off the inflation basket and put streaming services in. So, I mean, let's be clear. Your inflation is, our individual inflation is never there. But it's a good number. And the argument's always been that IMPC can't cut ahead of the Fed. Although I see Namibia last week was like, oh, hell to the leather, and they just cut. Can't wait anymore. And Namibia's never cut ahead of us before. or raised for that matter. But if we're getting a cut on the 18th of September from the Fed, and if the question is just how big, surely we get a cut the day after.
Yeah.
I'd be shocked if we don't, if I'm honest.
I would be too.
I think if we don't see even just a 25 basis point cut, the economy is going to be in a lot more trouble than what we think. Because even the US, that's had their inflation pegged at 2% for the longest time, still hasn't gotten down to 2%.
Yeah.
And it's something you mentioned a couple of weeks ago, Simon. You start braking before you hit the stop.
Yeah.
You don't brake when you're at the intersection.
But that's also our good governor who wants to have the debate around what. So he never says 3 to 6. Right? He says 4.5. Fair enough. And he wants that debate of shouldn't it be 3? And I think that's why he's breaking late. Because why else? To the point. Okay, so, I mean, could we have cut before the US? I think we could have. Just 25 points. It really would be fine. It really would have been fine.
We started hiking before the US.
Correct. If we had done it in July at 25 points, and then the US in September and then us again, all would be fine. But I think he's breaking late because I think he wants to, inflation is so much about expectation. And if he can get us down into the 3s and start to cement that expectation, we can start as a country having that debate, which I think we should have already started many years ago around, well, why 4.5? Because let's be clear, I went and did the research a couple of years ago on, so how were inflation targets set? And I expected these dense academic papers and things I wouldn't understand. I'd get the professor to help me. No, man, like New Zealand would like an even number. It can't be 3. 1 seems low. Okay, it's 2. Like, that's it. And then New Zealand went 2, so Canada went 2, so Europe went 2, so America went 2, and everyone's like, it's 2. Academia? Yeah, nothing.
There's no science behind inflation numbers. That's what we're taking from that conversation. But that's Market Matters for this week. Thank you once again to Ruan and to Danny for joining us. We love having you guys in the studio with us. Until the next one.
Thanks, guys. Cheers.
And we move on to our deep dive segment. We're taking a look at the empire that is Berkshire Hathaway as well as Warren Buffett. And we're joined in studio by a very distinguished gentleman who Simon has informed me he's known for over 20 years. Interestingly enough, the gentleman has been a professor for the last 25 years. Talking about Professor Adrian Saville, who is currently a professor at the Gordon Institute for Business Sciences. Prof, thanks so much for taking the time, because I call you that officially. Other people call you Adrian, but thanks so much for coming through.
Thanks,
I saw yesterday.
Just for the record, I've known Adrian for 25 years. From when, it was Bay Hill.
Was Bay Hill Capital, yeah?
Bay Hill Capital, but we're still both in our 20s.
What a fantastic
Just
memory.
for the record, I knew him since we were toddlers.
And you only found out today that he's a professor.
No, I've known for ages. I just didn't know the hierarchy. Doctor,
it's such a weird
professor,
thing, right?
guru, there's words.
Yeah. Before we get into the deep dive segment, I saw something on socials yesterday. Someone in the family is doing exceptionally well. So you're very happy, very chuffed with
proud
that.
dad. You
proud
picked up
dad.
on. So my daughter's in third year of her degree, and to sort of overshare right out the blocks. This is a young woman who 3 years ago I was dragging, kicking, and screaming through matric, and stuttered over the line, and man, she has absolutely blossomed. Hey?
Matric is a bearing of nothing.
So here she is banking first class passes in the final year of her psychology degree, just doing superb. I'm so proud.
Awesome.
Yeah.
I, for one, don't want to be the child of an academic, because the expectations are just out of this world, especially when your father is one of the leading academics in the country, possibly in the world. But all the best to your daughter.
I'm married to an academic.
That's not an easy...
You just know where you sit in the hierarchy of the household.
As long as everybody knows the truth, right? The deep dive. This was an interesting one to think about as well, because I imagine as a professor, you would have done multiple case studies as part of your MBA classes and all of that. And the Berkshire Empire has to have come up at some point as some form of a model case study or something that you can draw valuable lessons from.
Sure. One of my areas of fascination in trying to figure out the success of people and enterprises, the firms and the people that we adore and celebrate, often suffer from what's referred to, Phil Rosenzweig refers to this as the halo effect, that you look backwards and you explain successes by coincidence rather than by design. And this is the stuff of celebrity books. And Berkshire Hathaway is a great case in point. If you asked Buffett to start again right now, if you gave him the start point and his initial capital and said to him, do it again, would he be able to do it again? And if he is, then we're in the world of skill. If it's not, then we're in the world of luck. So absolutely, Berkshire Hathaway, that's a great example of the consideration of skill versus luck. And to put it into statistical terms, imagine lining up a couple of million monkeys in front of typewriters and letting them randomly press keys. Eventually someone would type a word, or one of the monkeys would type a word. It's a well-trodden thought experiment in finance. And I don't think Buffett's going to listen to this, so we're probably safe.
We'll send it to him.
Is he a monkey in front of a typewriter, or is he truly someone who is skilled? That's the fascination with this incredible investment record.
That's quite interesting, because as you say that, I think about a Naspers, a Kursbecker, where you hit 10 cents.
Yeah.
Would you be able to hit it?
But this is what the full by randomness is also about.
Exactly. That's exactly the point.
It's that. And how much of it, and I look back at my career, and I can identify points, and it's a long story, but short version, I'm here today because a photographer went to Pietermaritzburg and the person wasn't there, so he stopped at Botha's Hill, took a photo of me, and I ended up on the front page of the Sunday Times business section. My website went from no one knew it to 100,000 views, and there's those moments, and I can look back and identify and say, if that hadn't have happened, where would I be now? And how different? And maybe I'm still here, just in a but that immediately, then the phone starts ringing, and suddenly Simon Brown's not just some hippie in KZN buying cement stocks.
Simon, there's actually a brilliant Charles Dickens talks about moments in your life where there's just some golden link in a chain that happens, and were it not for that, where would you be now? If when you make this point about Buffett, it sounds like, well, what have you done? You're just grumpy. But here's an amazing stat. If you take Apple out of Buffett's investment decision and he doesn't buy Apple, do you know he actually underperforms the S&P 500?
Wow.
With that one decision.
That is crazy.
Now he took the decision, right? He took the shot.
Yes.
But
what if he hadn't?
But it's same. I mean, again, I look at my portfolio. Capitec 20 Rand was a defining difference to my portfolio. And I remember at the time, I mean, it was, you don't realize it then. So it's hindsight. And of course, all the risks that come with it. But there's another point to it, Adrian. If we go back to when he got Berkshire Hathaway, which of course was a bankrupt textile company, actually. Yeah. Could he replicate it in 2024? Not from his skill set, but from the market. Is the market got the patience, that quarterly go-go? I suspect that the 60s and 70s and certainly the early 80s, I mean, the 80s got crazy towards the end, was a different and more patient market. And maybe I'm completely wrong. I was not there. I'm not sure. But, Buffett had that luxury of permanent capital, but patient permanent capital, perhaps more than anything else, that I don't know if it exists so much anymore.
There's certainly a confluence of circumstance and things that have sort of aligned, whether you're Warren Buffett, whether you're Simon Brown, Adrian Saville, Jimmy Moyaha, there are things that kind of come together at a specific point in time. How do you then go from things just relying on things just coming together to actually making the skillful decisions? Because as you said, Adrian, luck and skill, but the skill part of it for Warren Buffett did come at some point. I mean, we take Apple as another example. He's just offloaded almost 400 million of those same Apple shares, and the timing of that ahead of what could potentially be the biggest financial recession we've seen since the 2008 recession. How do you then get from it's just skill or it's just luck to there's skill to it?
Maybe Buffett's herding. Hey? if you look at inflows into money market funds have hit record highs, $6.5 trillion sitting in money market funds in the United States. So Buffett's joined them.
Well, hey, when you've got a 50-year track record of beating the S&P, maybe this is how you sort of lock in your legacy.
Quit while you're ahead.
So in running a permanent capital vehicle, Buffett essentially, the single task that he has is almost that of a CEO of capital allocation, and I agree with Simon's suggestion that you have to wonder, or his curiosity. You have to wonder if you gave Buffett 2024 as a start point, if the market would be, investors would be sufficiently patient. The great, however, is he's got a permanent capital vehicle, so investors can get as impatient as they like and sell the Berkshire stock. He'd then be sitting with the same amount of NAV to allocate. So when you've got a permanent capital vehicle, you can not disregard, but you can really worry substantially less about the anxiety, the frustration, the impatience of the market and your investors. And is Buffett a shrewd capital allocator? Now, here we can start to go in the direction of skill and ask how many has he got right? And his win ratio, his success rate is overwhelmingly in the positive. And that then sort of puts my grumpiness in the box and says, just relax, Adrian. It wasn't just Apple that he got right.
Would the success, or would that win ratio be the same if he had a different investment philosophy? Because Warren's philosophy has always been never hold more than 10 stocks or so in your portfolio. Always keep a very specific
Highly
concentration.
Brilliant.
And that also inherently reduces the amount of chances you're going to get it wrong. So if you get 7 out of the 10 right, you've got a 70% win ratio. But if you get 7 out of 100 right, it's a very different conversation.
See, so here, Jimmy, is where we get into the business of figuring out if it is, Buffett that was just lucky, and now we write books about him and celebrate him, because how many non-Buffets have failed building concentrated portfolios, and there's no books about them. We don't hear about. They've just died quietly.
Or just track the S&P. I mean, maybe they just, bumbled along and did okay.
No remarkable success. You don't hear about them. They don't get invited to podcasts.
They're not topics of discussions on podcasts.
So, that's the statistical fooled by randomness that, Simon refers to earlier. Where we're stuck is, from a statistical perspective, we don't have a big enough data pool. He hasn't done this for long enough for us to be able to say with statistical confidence, he's skilled. So we have to here agree to be fooled by randomness. But,
I like that.
Where I'm convinced of his investment approach is the high conviction, high concentration. Just before we started recording, we were talking about the portfolio I've been running since 1996. And it started its life as a highly, highly diversified portfolio, increasingly concentrated, and today consists of just 13 stocks. Lucky 13. But, I can name those stocks. They make up, 7%, 7.5% each of the portfolio, so very high conviction. And it's had fantastic returns over, 25 years.
And that's a great point, because I look at my portfolio. I mean, I was learning markets and stuff in the 90s. The logic was, well, firstly, you bought Anglo, you bought Pick and Pay, and then you decided what to buy after you put those two in. And portfolios were 30, 40, 50 shares. And these aren't funds, these are portfolios. And I don't know who or what I read, and I want to say Peter Lynch, but I'm not sure if I'm right about this, one up in Wall Street, who said, no, you've got to go concentrated. So I sit on about, I typically sit at around about a dozen shares at any one. I've got ETFs and I've got Reg 28, but in my little portfolio, it typically sits at about a dozen because that concentration, if I own 50 stocks and one of them's Capitec, no one notices. So then what am I doing? Then just
it doesn't matter.
Go buy the ETF. And I love myself ETFs. But if you're out there and saying I'm a skilled stock picker, then it is around that concentration. And I think that is also something you get from permanent capital. I'm thinking Chris Seabrook from Saville.
Yeah.
That permanent capital gives you the luxury to step away from herding.
So yeah, I mean, it's as if you crept into my head. You stole my thought. So, Chris Seabrook at Savvest has compounded capital at 22% per annum since the late 1980s. This is just an off the charts record. Now, maybe Chris would listen to this one. There's a better chance that Chris would listen to this one. But if we said, is he lucky? Has he misstepped in some places? Absolutely, sure. He's made mistakes, but his win ratio is overwhelmingly better than the average. And that speaks volumes about shrewd capital allocation, astute skill. Piet Viljoen at Astoria, I think, is a similar case in point. And what's striking about those pools of permanent capital is Astoria is trading at 50 cents in the rand, and the net asset value of Savvest, 110 rand a share, trading at 75 rand a share, compounding at 22% per annum. You're being given gearing for free.
Yeah, you're buying rands for 70, 50 cents. I mean, which is just ridiculous.
So, in conclusion, when we look at, obviously, I guess we should probably conclude on the permanent capital side of the conversation and draw it back to what we've seen from Warren Buffett and the Berkshire Empire. The current Warren, the current Berkshire, 2024, liquidating Apple shares, sitting on $277 billion of cash, more treasury notes than the US Fed themselves, the guys that issue the instrument. What do you even do at this point? I mean, you've got permanent capital. Your son runs a farm. He actually herds. How do you now ensure that everything you've done over the last 50 years is sort of transferred into something meaningful? Because 300 billion, we round it off, call it $300 billion in cash could just disappear if the thesis and what was in Warren's head and what was in his mind, if that isn't sort of translated into, I almost want to say multiplying yourself into the world, so to speak, so that we have better investors going forward. 2024 is breeding a different type of investor, certainly one that doesn't look at, I'm going to be doing this for 50 years like Warren did it. There's a lot, because there's a lot more technology, there's a lot more advancements, there's a lot, you have quicker.
But you're going to live longer.
Fair enough.
So why not 50 years?
Yeah.
Jimmy, let's finish with a Jimmy thought. Jimmy Carville, is the advisor to Bill Clinton when Clinton is on his election campaign in the 90s. And James Carville has a lovely, lovely quip. He says, in my next life, I'm not coming back as a fantastic baseball player or as a cardinal, archbishop. He says, I'm coming back as the bond market. Because you can intimidate everyone. It's like there's a Buffett thing here, right? He's done with equities. Now he's coming back as the bond market or the short end of the bond market. But if you look at valuations on markets at the moment, and here, how long can you be wrong? But 3 stocks in the US are worth more than all of China. Something just doesn't square here. And to confirm my thesis, I'd like to say that Buffett's calling it that way also. These valuations just don't make sense.
So we're in line for a reset.
Yeah, but don't hold your breath, because I'm old enough to know that these resets can take time.
Yeah, they can take time.
Forever in a day. Yeah.
the investment thesis that is Warren Buffett and the Berkshire Empire. That's the deep dive. We'll leave it at that. And we move on to investor insights. And as we head into September, there's a lot of changes that are happening. There's a lot to think about. We have the implementation of the two-pot system on the 1st of September. We have the changes coming through for the CMA countries that we spoke about in our first episode, as well as the fact that we have the Monetary Policy Committee meeting that we just spoke about in our Market Matters. And with all of the information and all the expectations coming out on the 1st of September, I thought we'd take a look at just what the two-pot implementation looks like. And I know Simon and I share this view that you should leave it alone.
Yeah, can we go home now? Just leave it alone. So, and I can't remember the exact numbers, but someone in their 20s right now who's got 300K in a Reg 28 and therefore can draw out 30 and takes out that 30, they're going to have like a truckload less money at retirement. Now, I appreciate debt, holidays, hamburgers, all of those sort of things. I think it's Nedbank and Investec have both estimated around 40 billion ZAR is going to get pulled out.
I think it was closer to 80 from some of the estimates.
Yeah, it is a lot of money. Of course, it's going to be spent. We can see our stock market salivating at the thought of it coming. And when I say spent, not on stocks, some of it, but on steer
On the companies that are on the stock exchange.
Correct, Ramondo. But I mean, you know what? So I like the idea, right? Because in the olden day, you would quit your job to access the money, and now you'd have nothing left. Now you quit your job, well, you can access the savings pot. There's some money that the only way you access it is death or retirement. End of story. Which means that if we roll forward 40, 50 years, South African savers and retirees will be in a better position because of that two-pot. The thing is, it's designed for proper emergencies, not my credit card needs saving. Because what do? You take money out of your two-pot, you save your credit card, and now you've got a shiny credit card that you go swip, 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 and man, a day and a half at Rosebank, and it's back to where it was before. Paying off debt, I hear you. I mean, if you're being crunched under with debt, okay, there's perhaps an argument there to relieve that. It's what I say to folks. If you, and people hate this, but it's true. If you're struggling right now on surviving on whatever you earn, for someone earning 20K and say it's not enough, I can't survive, I need 30. That is not going to solve the problem. It's your relationship with money that is the problem. And if you've got a debt problem now and you take 30K to solve it, sure, but then don't you have a debt problem next time or in 6 months or...
But this is the thing, right? I think for me, what I disagree with is the conversation and the way it's been framed is you'll have access to this, you'll be able to use it, whatever. We've just glossed over the implications of accessing the money, right? And those implications are quite serious. We say 30,000, but it's not 30,000.
Well,
it's capped at, it's 10% of what you've got, but capped at 30,000
Yes.
come the first. That 30,000, when you withdraw, is going to be taxed at your marginal tax rate. So if you're an individual who earns in the highest tax bracket, that 30,000 of yours is going to be taxed at 45%. After it's been taxed at 45%, the fund manager still has the right to charge you a fee on that particular withdrawal. It is a withdrawal. They're charging you an administrative fee. So realistically, you might only end up getting 15,000 Rand of this.
And that's if you don't owe money to SARS, because if you do...
SARS is a preferred creditor on everything. So if there is a debt to SARS, it would go to settle SARS first. So assume you get out the 15, even assume you get out the 30,000 best case scenario, which is impossible because of the tax rate, right? So assume that, call it 18 to 20 or 15 to 20 is a good sort of wide enough range of what you get. The amount of debt that you are going to be paying off, the likelihood that you only have a 15,000 Rand credit card balance is extremely slim. But when you look at, again, implications, for you to recover that amount of money into your pension fund by the time you retire, even if you're contributing 1,000 Rand into that savings pot every single month, you're going to have to contribute for the next 30 months without withdrawing again just to get back to zero.
Just get back to zero.
Assuming you're contributing 3,000 Rand a month towards your retirement, of which 2,000 goes into the other pot and 1,000 goes into the savings pot. So to rebuild this, first of all, is not going to be an easy exercise, especially if you don't have time. Now, if you're taking the money to settle off the last little bit of a home loan that you've been paying off for 20 years. Again, I ask, why not just wait an extra month, pay off the installment as you were going to anyway, or as you originally had planned? I think it comes back to what you're saying, Sai, around the relationship with money and the narrative that has been put forward around the fact that this is a good thing for people retiring. I think that's what people need to be looking at and people need to be thinking about very carefully. Is it really a good thing for us that are retiring? It's nice, it's all good and well to have more money in circulation, have more accessibility towards funds and all of that. But the reality is that 30,000, if left alone for another 5 or 6 or 7 years, or even left alone for the 30 months that you were taking it out from, will that be beneficial or harmful towards your overall retirement? And the clear answer is it's going to be harmful.
So some quick numbers. Assuming 1% fee, assuming 30,000, assuming 6% real return, in other words, after inflation, over 40 years. So you're a kid here. 250 grand in today's money at retirement that you're throwing away.
250,000. That is R250,000 rand.
Now, that's top of my head. Someone out there with a calculator just proved me wrong, but round numbers. I'm running the math in my head. 250K that you just threw away. Thanks, don't want it.
Now, we've spoken about this understanding that people are maybe not necessarily living for the now, but dealing with immediate challenges.
It's been a tough 4 years.
It has been a horrendous 4 years. It doesn't matter where you are, unless you're a CEO earning millions. And I say this because I saw a very interesting stat from, I think it was the Daily Investor. They published the earnings of the private higher educational institute CEOs. And I'll pull up the article. I saw it. I was reading through it and I was astounded to see just what the daily earnings are like, because we're not talking monthly earnings. We're not talking, oh, there we go, there it is, there's the packages. So the annual remuneration for the CEO of Advitech is 22.3 million. For the CEO of Stadio is 19.71 million. For the CEO of Curo is 8.37 million.
Yo, what did Kobus do?
Kobus
only got 8.
Kobus Loopsa only got 8 million in annual remuneration, which works out to 23,931 rand per day.
That's about 5x the median salary per month for a South African.
If you look at Chris Forster's salary, Stadio, it works out to 54,000 rand per day. So he can afford to withdraw from that retirement because he will put the money back almost immediately. But that's not the conversation that we're having. The conversation we're having is around whether or not it's smart to access this 30,000 come the 1st of September. And there is no conceivable thing that we've thought of at this stage that makes sense. If you happen to think of one, please leave one in the comments.
No, there's one. Dread disease.
Fair enough.
Otherwise,
but that's
no.
unavoidable. That's
No. You got a dread disease. Your Medicare doesn't quite cut it. Fair enough. Otherwise, no.
There we go. Let's look at our wall. Let's update the wall while we are here, because there are a lot of things that have been moving around and a lot of things that have been... I was looking at the charts. Last time you and I updated the wall, we spoke about how everything is just in the green. Everything is up. Everything is higher than what it was and all of those sorts of things. And I'm just looking at some of the big moves this week, right? I'm looking at ABSA. ABSA this week has had a rocker of a week, because not only did they finish positive last week, they gapped up this week to above 160 Rand a share. We're closer to 170 Rand a share. We're up about 3.5%. And they recently, this week, Ari Rautenbach decided that he would take... Oh, that brings the total, if I'm not mistaken, to 6 CEOs in 5 years in search of the 7th CEO, assuming the interim number 6 doesn't stay on.
And the interim number 6 can't do anything in the meantime, right? Because like maybe he's going to be there, maybe he's not. So he's going to be sitting tight. And man, Joburg has had like more mayors, but other than that...
Joburg has had more mayors than ABSA has had CEOs. But
neither of those are a good thing.
This is not something to be proud of.
Aspirational.
No, this is not something to strive towards. It's definitely not what you want to do. But what does that mean for they gave us results at the same time. Let's not gloss over the fact that they gave us results as a company. But for the market to stay positive, when you see a CEO set to resign from a company, it always brings about the question around succession and what you're going to do and all of that. And that always creates volatility where it comes to local stocks. It always has in the past. This time around, it was a good thing.
And it creates volatility. And particularly when, let's be clear, the ABSA board is really bad at appointing CEOs.
They've had a couple of tries. Oh, sorry. It's worth noting.
You're appointing CEOs. You're not kicking conversions.
It's worth noting that these appointments that we speak of, the 6 CEOs in 5 years, is just since 2019 when Maria Ramos left.
Yes.
So this is not in the entire history or the entire tenure.
Didn't she?
Yeah, so she left sort of towards end of 2018, and this kind of started from 2019. But this is not in the last 10 years. This is just in the last 5 or 6 years.
The thing is that patently ABSA can bundle. When you look at the big banks, everyone would be like, yeah, ABSA's the lagger in terms of share price performance, but also just in terms of results performance. Okay, it's like it's the little kid in the corner. But it's also not expensive. A PE of 7 and change. The dividend yield of 8 and change, a price to book of under 1. So I think the market looks at it and says, yeah, look, this is not, the Standard Bank of the first round, or even a Capitec, which is typically what the banks that people are liking in South Africa. But at that price, and patently, they don't need a CEO. And maybe the board gets it right this time and they get a CEO and they start actually, moving to 1.5 book instead of 0.9 book. And then suddenly this is a double bagger in 3-5 years. And I'm not, and I can't see our other banks doubling in the next 5 years. But if ABSA actually got a new CEO who can keep the job and implement strategy, and it's a good strategy and it wins the market share and makes some profit, a lot of buts in that statement. If they can, well, this is our cheap bank. And you know what? Some people prefer cheap.
Maybe they need to be single for a while.
Okay.
We'll see. We'll keep an eye on them. We'll certainly keep an eye on them. Are we adding them to the wall at 168 Rand a share? Just under 170? I mean, share price has been on the up, bounced quite nicely. It's been looking a lot more positive. We did get to just over 180 Rand towards the end of May. All-time highs, probably about 2022 highs, are around just north of 200 Rand a share. So there is still quite a bit of room in it, some legs. But at 200 or 220 a share, it's kind of a triple top if you're looking at a chart. I don't know if we'll break through that. Are we liking it at 170?
Sure. I mean, it's not my favorite bank, but it's a cheap bank. And at 170, 169 as we record, it's cheap, man.
It's cheap, and it's cheaper than some of the other banks. We will keep an eye on that, and we'll see what it means from a dividend and from a holding perspective. Let's take a look at Sibanye-Stillwater, because they had their lithium plant finally go. Well, they'd been starting with the plant, and they finally got the last bit of capital, last 10 billion Rand into that. One of the most, if not the most diversified mining companies in South Africa. And that was a very bold decision taken by Neil Froneman and his team. And I've always respected him for that. It takes a very special kind of CEO to say, the business that we have when we started the business was just 3 gold mines. We're now going to go from gold into everything.
And they weren't the best gold mines either.
They weren't. And now we're no longer a gold miner. We're literally the definition of a diversified miner. We've got gold interests. We've got nickel interests. We've got lithium interests that are now coming online in Europe. And I remember speaking to their investor relations team this week as well on radio, and I threw out the question. I said, okay, if you're a diversified miner, are you going into copper? And they said, well, why not?
Why not? Yeah. Look, I mean, it's a horror chart. They got their money for the lithium project. I mean, they're not yet producing lithium. That's still going to take some time. They did that weird thing with selling gold forward, and I can't decide if I like it or not. So what did they raised a whole lot of capital, so they get paid for their gold now and they deliver it in time. And I, in a bull market of gold, I mean, I remember, was it AngloGold Ashanti 15 years ago who had that crazy hedge, and they were selling gold all the way down there and the spot market was up here. But I mean, in the sense, they're looking for short-term solutions in terms of of debt, and maybe why not? I like Sibanye Stillwater. I hold it a little bit. I keep on picking it up. It's sort of at 17, and then it goes, and then it just comes back to 17, and I'm like, we've been here before. I just, at this point, the world looks at them as a PGM miner, and the world doesn't want PGM miners.
You know what? I like Sibanye. I'm holding Sibanye. I think everybody should get into Sibanye. So it's at 19 Rand at the moment. 17 Rand is a good support level. It's held at 17 for the longest time over the last 4 years. And even if the world sees them as a PGM miner, right? And we're transitioning away from PGMs because of EVs and all of that stuff. What goes into EVs? Lithium, nickel, copper, cobalt.
Yeah. No,
maybe very little cobalt, but the other three precious metals are, I'm now calling them future metals. Sibanye is exposed to two out of those three. On the lithium side, they told me about that project, the Keliber project that they're doing in Europe now, that they've got the financing for. That's going to be the biggest, and it's the first project of its kind in Europe. Now, Europe is set to lead the market on EVs because they want to do this transition and they've got the infrastructure to do it and all of that. And if that is the case, then these guys aren't going to be a PGM miner for much longer.
Well, agreed. Except what's the first law of big projects? Over budget. Second law, over time. But aside from that, I agree with you. I mean, if we roll this forward, I don't know, is it 5 years? Is it 3? Is it 10 years?
I'd put it at 10. I mean, we know Elon Musk has been on this drive on their side. BYD in China has been doing their thing. It's been great. It's been...
For 10-year view, this is a steal. I just think it could be a steal for a lot longer.
Patience. Let's wrap up with some MTN. Why not, right? MTN gave us numbers. MTN's numbers looked interesting. And the Naira conversation was always a problem. It's been a problem for the longest time. Numbers came in and they did not look good. MTN's in a loss, headline loss. And yet the market decided, okay, we'll see those numbers and we'll respond to that by having your share price up 17% for the month.
Yeah, because here's what I don't understand. The Nigerian Naira and the Ghanaian Cedar, and then there's the
Ugandan
shilling. And let's stick with the Naira. It's the same across all three stories. Massively devalued over the last year, humongously devalued against the dollar and against the ZAR. It's not getting that back. It's not coming back to levels it was last year. Those levels are now gone. And if it is coming back to those levels, we're going to be a very much lot older. So if they manage to lose 256 cents per share in this particular period, and let's be clear, this was 6 months, so 5 Rand for the year, I'm just like betwixt. I mean, I appreciate, my sense is, I suppose the short version is they've reset their Ghanaian, Nigerian, and Ugandan earnings to a new low base. Because particularly if you looked at Ghana and if you looked at Uganda, the businesses were doing great, absolutely great, until you bring it back.
Subscriber numbers are still growing. If you keep it in that currency, it looks phenomenal.
But when you bring it home, it's not. And that bringing it home is not going to get better anytime soon. So, I don't know. Look, I sold MTN many, many years ago, like 175, happy ever since. It's been insane the last couple of weeks. But I can't see how it gets back to sort of like previous earning levels in any hurry, because it's in a largely ex-growth utility market. Fintech is the big exciting component, and I get that. But fintech is also, you do a show. How many fintech pitches do you get a day of new fintech somewhere in the continent, etc.? And they've got brand, and those brands are humongous. MTN, one of the biggest brands in the continent. No dissing that. But I struggle to get excited about these stocks. Technically, it looks good from the chart perspective, but man...
You know what? I saw the share price dip all the way down to about 72 Rand. And at that point, I thought, surely, first of all, we can't go lower than 50 Rand because the pandemic was 50 Rand and we've survived that. But at 72 Rand, having come off of highs of just shy of 200 Rand, 72 Rand was a steal, right? So I liked it at that price. I still like it now below 100 Rand. And I think the way the market is responding to it now is testament to, one, how strong the management and leadership team is within MTN to be able to map this out, and that's a big thing.
A big change from a decade ago, and kudos to them
right?
for getting that.
But the second thing is what you spoke about brand, about footprint, about reach, about presence on the African continent. MTN has divested from markets like Afghanistan and other Middle Eastern markets and have focused their efforts on the African continent to say we're going to be the number one telco on the continent, kind of in our positioning and in our marketing. And you're seeing that guys like Vodacom are playing catch up with Egypt, whereas MTN, in locking down Nigeria, was able to effectively lock down such a big population. So even when we look at fintech and the servicing of fintech, Nigeria is a very big hub of fintech developments and fintech companies. Who's going to move all of that money for them? Who's going to facilitate them?
They almost the rails.
That's it. So you're now moving into an enabling environment, an infrastructure environment. It's no longer just about data. It's no longer even if you don't enable the transactions themselves through the Momo platform, the data to process those transactions requires a SIM card. Where does that SIM card sit?
That's an MTN SIM card. That's a good story.
So it's still a good story. It's still a good play. I still happen to like the share. Would I like it at a better price? No, I've seen enough pain. I think the price, where the momentum that it's got at the moment, it needs to break back above 100 Rand. Make a new support base at 100 Rand and move on from there. But we're liking it nonetheless. Those are the picks for this week. It's been Investor Insights. We'll update the wall. We will move things around if we think we need to move things around. But thank you for tuning in. Thanks for sticking with us throughout the episodes and for giving us your ear. Remember to follow us on all socials. We are on all social platforms under Insider Exchange. Like, subscribe, tell your friends to subscribe, and maybe we'll even run a competition. But until next time, investing isn't hard. Just try it.